There's an ETF sitting in your dividend portfolio right now that is quietly handing you back your own money and calling it income. And if you are building toward the point where dividends actually replace your paycheck, that one fund could be the reason you never get there. This video is about 5 specific ETFs that look great on paper, show up in almost every dividend portfolio, and have a real mechanical problem that makes them a bad fit for anyone trying to live off dividends in America. Not bad in a vague way. Bad in a here is the exact math on what this is costing you kind of way. Let us start with the fund that trips up the most experienced investors, AMLP, the Illyrian MLP ETF. It holds pipeline companies and pays a decent yield. The problem is buried in how it is legally structured. Most ETFs elect regulated investment company status, which means the fund itself pays no corporate tax. Gains and income flow through directly to you. AMLP does not do this. It is structured as a C corporation, which means it pays corporate income tax at the entity level before you ever see a dollar. Federal corporate tax is 21%, and when you add state taxes, roughly a quarter of any unrealized appreciation inside the fund gets set aside for a tax bill before it ever shows up as your NAV gain. A standard equity ETF has 0 of that drag. The second fund is NVDY, the Yield Max NVDA Option Income ETF. The distribution rate on this fund is eye-watering, north of 90% annualized at times. But here is what the fund's own regulatory filing reveals. Every fund that pays distributions from sources other than investment income is required to file a 19A1 notice telling you exactly where the money comes from. NVDY's most recent distribution was 93, 71% return of capital, and only 6. So out of every dollar paid out, less than 7 cents was real income. The other 93 cents was your own principal being handed back to you. On a $50,000 position, at a quoted 90% distribution rate, that implies roughly $45,000 in annual payouts. But only about $2,700 of that is real income. The other $42,300 is your own capital being returned in installments. You are not earning income. You are slowly liquidating your position and calling it a dividend. The third fund is QYLD, the Global X Nasdaq 100 Covered Call ETF. This one is everywhere, and it has a structural problem that is just math. QYLD writes covered calls on 100% of its Nasdaq 100 exposure every single month at the money. That captures maximum option premium, which generates the high yield, but it also surrenders almost all of the upside. The average annual NAV decline over the fund's lifespan is 3. On $100,000, that is roughly $3,720 per year in principal decay before you even ask whether the premium collected replaces that loss. The fourth category is REIT-heavy dividend ETFs, held in taxable accounts. The issue is not the yield. It is the tax treatment. REIT dividends almost never qualify for preferential qualified dividend rates. In 2024, roughly 78% of REIT dividends were taxed as ordinary income at your full marginal rate. For a married couple in the 22% bracket with $50,000 in a REIT ETF at a 3, 7% yield that generates $1,850 in dividends. But roughly $1,443 of that is taxed at 22%, which is about $317 in federal tax. If that same income came from a qualified dividend ETF, the bill drops to around $277. The gap compounds every single year. The fifth issue is international dividend ETFs held inside a Roth IRA. When a foreign company pays a dividend, the foreign government withholds 15 to 30% before it reaches you. In a taxable account, you can claim that back as a foreign tax credit. Inside a Roth, you cannot. The withholding is permanently gone. The average drag runs roughly 5 to 1% per year. On $50,000 at zero, 75%, that is $375 per year in permanently forfeited yield. Over 20 years, that compounds into a 5-figure gap versus holding the identical fund in a taxable account. Here is the bottom line. 5 funds and 5 different mechanisms, and none of them show up as a warning on your brokerage statement. You can take any of these numbers and plug in your own position size and run the math yourself. That is the whole point.